Welcome to the Wall Street Wish List, an investment shopping list from seasoned analysts. And each of the analysts featured today are from Noble Capital Markets, an SEC-registered, FINRA-licensed broker-dealer. Before I introduce the analysts, I want to remind you that this program is provided for informational purposes only, and none of the content should be interpreted as a recommendation or solicitation to buy or sell securities. Investment decisions must be made by you or with the support of your financial advisor. A complete disclosure statement follows each analyst's presentation. Let's get going. Michael Kupinski is Noble's Director of Research and a Senior Research Analyst covering media and entertainment stocks. Over his more than 30-year career, Michael has been featured on most of the financial networks, won numerous awards from the Wall Street Journal and other leading investment sources for his stock picking and analytical prowess, and yes, he's even won an Emmy. Welcome, Michael Kupinski.
Thanks for the introduction. I follow very broadly the media and entertainment industries, which are considered to be consumer cyclicals. Of course, the best time to buy a consumer cyclical tends to be in the midst of an economic recession, or when that appears that maybe interest rates are waning a little bit, but this is all very difficult to predict. The stocks may not react similar to past recessions. Many companies have recently changed business models and created recession-resilient qualities. In addition, these stocks tend to react differently and quickly, outpacing the general stock market when the economic prospects brighten. So they're tough to time. The best course is for investors to take an accumulation approach to this sector in a rising interest rate environment. I'm going to highlight 4 buckets of stocks to consider. The first bucket, stocks that are trading near historic lows or near 52-week lows. The first stock I'd like to highlight happens to be one of my favorites, 1-800-Flowers.com. The stock symbol is FLWS. This is a leading e-commerce company that is more than just flowers. It owns iconic brands such as Harry & David, Sherry's Berries, The Popcorn Factory, Cheryl's Cookies, and Personalization Mall, among others. During the COVID pandemic, the company grew revenues over 40%, and it's largely held on to all of those revenues. It is well positioned to benefit from the secular trend of consumers ordering online and through voice-activated devices. Due to economic concerns, the shares are not only trading near 52-week lows, but the shares are trading near 5-year lows, well below pre-pandemic levels. And again, this is a company that grew revenues by over 40% during the pandemic. I believe that investors have underestimated the company's ability to grow even through the current economic environment. Near current levels, the shares are trading at about 10.2 times enterprise value to my 2023 cash flow estimate. The shares are rated outperform with an $11 price target. And one of the key catalysts for the stock is the upside surprise potential, which appears possible largely because analysts have slashed estimates anticipating an economic recession. I view these shares as among my favorites in over the $500 million market cap group. The next stock I'd like to concentrate on is Codere Online Luxembourg. The stock symbol is CDRO. This is an established casino brand out of Spain that is one of the first movers in the newly regulated and growing online casino sports betting markets in Latin America. I'd like investors to think about the World Cup soccer, which is ongoing right now. Codere has a strong foothold in Mexico already, which it continues to expand in other markets such as Argentina, Colombia, and others. Notably, management has expertise in navigating the complicated regulatory landscape in Latin America, which can serve as a barrier to new competition. The CDRO shares are down roughly 70% since its IPO in December of last year. And that's despite the company actually executing its growth strategy. It's hit expectations. Moreover, the Codere has a strong cash balance, 72 million euros as of September 30th. And it has the ability to fund its growth, and it has no long-term debt. Near current levels, the shares trade at just 0.3 times enterprise value to 2023 revenue. I rate the shares outperform with a $9 target. That reflects a multiple of 2 times revenues. Very compelling story. Cumulus Media is another one of my favorites. The stock symbol is CMLS. It's one of the nation's largest radio broadcasters. The company has significantly reduced its debt through a financial restructuring several years ago. As of September 30th, the company had $118 million in cash, $740 million in long-term debt. But what's important is that the net leverage is 3.7 times cash flow. It's the lowest it's been in over a decade and one of the best balance sheets in the industry. The large cash balance, a $200 million credit facility, and low debt leverage profile really positions this company to weather the economic headwinds. Furthermore, the company generates positive free cash flow and has the ability to further reduce debt or return capital to shareholders, possibly through share repurchases. Near current levels, the shares trade at 5.6 times enterprise value to 2023 adjusted EBITDA, which is considered to be what I consider to be recessionary type valuations. The shares are rated outperform with a $20 price target. The next company I focus on is Lee Enterprises, symbol LEE. This is not the old newspaper company that everybody might think about, their father's newspaper company years ago. The shares trade at the low end of the company's 52-week trading high by about 40%, but it's also at the lower end of the company's 5-year trading range. The company boasts industry-leading growth of its digital subscription platform and overall digital revenue that accounts for more than 30% of total revenues. Importantly, the company has grown its digital businesses while simultaneously reducing debt since 2020. Lee has reduced its debt by $113 million, and management plans to continue deleveraging the balance sheet. We believe Lee's digital transformation has been largely ignored by investors, yet we believe the story would be hard to ignore as that transformation continues. Certainly, as you look at companies like the New York Times that has transitioned, this company has a pathway towards better values in the marketplace. Given that there's no fulfillment cost associated with its additional digital subscribers, we believe that digital margins will continue to expand as digital revenue continues to grow. We rate the shares outperform with a $50 price target. Another company that's in the midst of a digital transformation is Beasley Broadcast Group. The symbol is BBGI. This is a medium to large market radio company that's migrating to digital media. Right now, it is expected to have 20% of its revenues by the end of this year coming from digital media. The BBGI shares are down roughly 50% year to date over concerns of the economic environment. And again, the company has recently been affected by disruptions to national advertising as well as some choppiness in local, largely due to those economic headwinds. Yet there's several mitigating factors to drive revenues, such as sports betting category, which is expected to provide a big boost in the company's radio stations located in Massachusetts. And of course, as I just mentioned, they have growing digital revenues, which now account for 16% on its way to 20% by the end of this year. Additionally, management recently implemented a $10 million annualized cost reduction and has been strategically retiring debt on the open market at a discount. We believe the company is set to benefit from growing digital revenues and expanding margins while improving its leverage profile, and that should reduce the risk to investors and be a key catalyst to higher stock valuations. The shares are rated outperform with a $3 price target. The next bucket of stocks that I'd like to talk about are companies that have recession-resilient qualities and may react quickly to improved economic prospects. Here, I'd like to focus on one of my favorite stocks in the industry right now, especially for those that are under $500 million market cap, and that is Intervision. The stock symbol is EVC. This company transformed from a television and radio-centric company to a company that generates 80% of its total company revenues from its fast-growing digital media segment. Its digital business rep firms like Facebook, TikTok, Twitter, Spotify, and some of the fastest-growing markets for social media worldwide, including Latin America, Asia, Africa, and the Middle East. While digital media growth may slow during an economic downturn, we believe that digital media should still grow revenues, given the developing nature of these platforms in these emerging global markets. Plus, the company has a pristine balance sheet, $121 million in cash, and virtually no net debt. Finally, the EVC shares currently trade below its broadcast peers and do not reflect, in my view, the compelling valuation of its fast-growing digital media businesses. I view the EVC shares as among my core investments in a media and entertainment portfolio. And again, I view the shares as among my favorite for under $500 million market cap. The next stock that I like to chat about is another one of my current favorites, Townsquare Media. The stock symbol is TSQ. Townsquare started as a radio company focused on small and medium-sized markets in the United States. Under the direction of CEO Bill Wilson, the former president of AOL Media and senior vice president for worldwide marketing at Bertelsmann's Music, the company has transitioned to become a digital media first company. Over 50% of its revenues are derived from its fast-growing digital media businesses. And a large portion of those revenues come from predictable subscription revenue. Importantly, the company's concentration on small to medium-sized markets with the combination of these attractive digital media businesses allows it to be somewhat resilient to the vagaries of the economic cycle. And to that point, I'll give an example. During COVID, the company's digital media businesses actually grew at double-digit rates. As a result, it tends to outperform most of its radio peers in terms of revenue and cash flow growth. But in spite of that, the TSQ shares trade at a discount to its peers, roughly at 5.6 times enterprise value to our 2023 estimates, below its peers, which trade as high as 8 times. We have an outperform rating on TSQ and a $23 price target. And again, I view this company as among my favorites under $500 million market cap. The next company I'll concentrate on is another diversified company that has recession resilient qualities, and that is Salem Media Group. It's among the most diversified of its radio peers. This company has a large 30% of its revenues derived from block programming. Many of the buyers of block programming have been clients for decades. In addition, the company tends to benefit in election cycles, given its orientation to the Christian and conservative community through its publishing business, its conservative Christian radio programming, and influx of political advertising in election years. The company has attractive growth businesses in businesses like Salem Surround, a digital agency business, and Salem Now, a subscription-based business. While the company has a fair amount of debt, it's about 4.7 times debt to cash flow. It's relatively high, but it's below past recession cycles. And given that consistency of its revenues and cash flows, I believe it can maintain a relatively high level of debt. Notably, the shares are trading at a modest 5.7 times enterprise value to our 2023 adjusted EBITDA estimate. And that, again, is below industry averages. I rate the shares of Salem, SALM, as an outperform with a 525 target. The next company I'd like to concentrate on is a company that's gone through a transition, Harte Hanks, stock symbol HHS. This is a global customer experience company operating in 3 distinct segments: customer care, fulfillment and logistics, and marketing services. And what's important is that each one of those segments offers compelling growth opportunities for this company. After a series of management missteps, the company has ridden itself of unprofitable revenue and cash flow. It's streamlined its operations. It's now focused on revenue and cash flow growth and positive earnings, with initial success exceeding expectations. Investors have been overly concerned about the company's unfunded pension liabilities, which have significantly decreased to a modest $38 million in the last month, due to the fact that we've seen rising interest rates. Near current levels, the shares trade at an attractive 5.3 times enterprise value to 2023 adjusted EBITDA, and that includes its pension liabilities. So if you back out the pension liabilities, which I believe are actually being mitigated by rising interest rates, these shares trade at a modest 3.1 times enterprise value to cash flow. We have an outperform rating on this stock with a $22 target. And I believe that the key catalyst toward higher valuations here will be diminished concern over those pension liabilities as we see interest rates rise. And of course, we're anticipating that the company is going to be generating free cash flow and paring down debt, building cash positions, and will likely, in my view, see upside revenue and cash flow surprise potential here. Another company I'd like to concentrate on is Travelzoo. The stock symbol is TZOO, TZOO. This is a media company that provides travel, entertainment, and local deals to over 30 million members worldwide. This company has counter-cyclical tendencies in that airlines and hotels tend to offer deals and advertise when business is not strong, when hotel occupancy is low, for instance, or when airline seats are not filled. In other words, airlines then need to advertise and hotels need to advertise on Travelzoo's platform to get those members to travel. We believe that Travelzoo's business appears to be accelerating into this fourth quarter as we're starting to see the economy slow a little bit. In addition, the company recently plans to become a major player in the metaverse with virtual travel. Of course, that's a trend that we think is going to evolve over the next 3 to 5 years, not something imminent, but for those investors that have a longer term time horizon, I think it could be a really attractive business. Near current levels, the shares trade at a historic 5-year low, trading at 5.7 times enterprise value to our 2023 adjusted EBITDA estimate. The valuation is below the average trading of 8.7 times to 28.6 times over the past 20 years. The TZOO shares are rated outperform with a $9 target. And again, the key catalyst for the shares in the near term is demonstration of the improved revenue trends at that company, again, which I believe will become evident in the upcoming quarter. The next company I'd like to focus on that has recession resilient qualities is Digerati Technologies. The stock symbol is DTGI. This is a provider of cloud-based telecommunication services specializing in UCaaS, which stands for Unified Communications as a Service, solutions for small to medium-sized businesses. The company operates in high-growth states, including Florida, Texas, Southern California. And as such, it has recession-resilient qualities given the growthness of these markets. In addition, the telephone services would be the last service that a business would cut. The company has a lot of debt, but it plans to merge with a SPAC that should improve its financial viability and accelerate the company's compelling roll-up acquisition strategy. With the merger, the company would also be able to uplist to the NASDAQ, which could be completed by the end of the year. The DGTI shares are viewed as a high-risk, high-reward investment, and the shares are rated outperform with a 15-cent target. Again, the completion of the merger would be a key near-term catalyst for this stock. Yet another company that has recession-resilient qualities is a company called QuoteMedia, stock symbol QMCI. Simply, the company provides financial market information and streaming financial data solutions to media companies, online brokerage companies, financial services companies. It offers streaming real-time quotes, market research, news, charting, filings, corporate financials, portfolio management system, and data leads, among others. The company operates in very large market, and it's relatively small in this space, but it is much more nimble than its peers and doesn't have the large overhead that its peers have. Its solutions are typically lower cost, and as such, potential customers likely will find its solutions more compelling, especially during difficult or challenging financial environments. We anticipate that the company will have compelling double-digit revenue growth and double-digit cash flow growth through 2024. In my view, the QMCI shares do not currently reflect that type of attractive growth. Near current levels, the shares trade at just 6 times enterprise value to our 2023 adjusted EBITDA estimates, far below the double-digit growth potential that I mentioned. The shares are rated outperform with a 35-cent price target. In my view, the key catalyst for higher stock valuations with this story will be an acceleration in that revenue growth and demonstration of that double-digit cash flow growth at the company. The next small cap stock that has recession resilient qualities is Direct Digital Holdings. The stock symbol is DRCT. Direct Digital is a programmatic advertising company consisting of a sell side and buy side segment with a focus on working with multicultural underserved communities. This company is growing at a rapid pace, with its sell side platform revenue growing 720% in the most recent quarter. The company's focused on multicultural publishers, make it the place to go for any advertisers that are attempting to target those specific audiences. As such, the company has cornered a portion of the market that in aggregate is quite large, reflected in the company's growth profile. Notably, the company is growing at a rapid pace, while other advertising related companies are really cutting guidance and actually are seeing revenues decline. We believe that Direct is a gem among the digital advertising landscape with a truly differentiated offering. And as such, we rate the shares outperform with a $6 target based on a DCF analysis, which we believe could be conservative. Next, I'd like to talk a little bit about television stocks. Now, traditionally, the television stocks would have been considered to be very cyclical, given that the industry was most reliant on economically sensitive advertising. But since 2005, that changed. The industry revenues shifted to more reliable retransmission fees from cable operators, which now account for more than 40% of total revenue. And as such, I would like to highlight two of my favorite TV stocks. The first one happens to be one of my favorites, EW Scripps. The stock symbol is SSP. Next year, 75% of the company's TV households come up for renewal with the cable operators. Notably, of that 75%, 20% of those subscribers are expected to have at least a 50% increase in retransmission fees. In addition, the company is well positioned to benefit from cable cord cutting, which happens to be a trend. It has a stable of some of the most notable networks such as ION, Bounce, Core TV, Grit, and among others. Finally, the company has one of the best TV footprints to benefit from the influx of political advertising expected in 2024. Near current levels, the SSP shares trade below its peer group averages, near recessionary type valuations in my view, and the shares tend to outperform the industry sector when the sector is once again in favor. The shares are among my favorites, trading at 6.7 times enterprise value to my blended 2023 and 2024 adjusted EBITDA estimates. That's below its peers. The shares are rated outperform with a $23 target. The next TV stock I'd like to mention is Gray Television. The stock symbol is GTN. This is considered to be among the best managed in the TV broadcast industry. The company boasts a portfolio of strong number 1 or number 2 ranked stations in small to medium-sized markets. These markets tend not to have the large economic swings of some of the larger markets and have less competition. And consequently, the company has consistently outperformed industry averages in terms of its broadcast peers in both revenue and cash flow. Furthermore, with it having a number 1 or number 2 ranked stations in most of its markets, the company captures the lion's share of political advertising during election years. With political advertising having very high margins of 90% plus, the significant influx of cash flow that comes from that political is likely to be used to pare down debt, or it can be used to return capital to shareholders. The company recently acquired a large TV station group and has significant amount of debt to pare down, but the company has managed high debt leverage before and should make significant progress as we see debt reduction in 2024. Near current levels, the shares trade at 6.2 times enterprise value to our blended 2023-2024 adjusted EBITDA estimates. And again, that's well below historic trading averages in the range of 8 to 12 times. The shares are rated outperform with a $25 price target. Turning next to my bucket number 3, which are companies with the most favorable risk-reward relationships, I would like to mention Motorsport Games. The stock symbol is MSGM. Now, this one is not for the faint of heart. This company has a lot of debt, and it has a profile which has a continuing going concern issue. The shares are down roughly 85% year to date as investors come to grapple with the company's funding needs. With a monthly cash burn of about 1.5 million, the company will need additional funding to operate through the end of the year. With exclusive licenses to make games for NASCAR, Le Mans, IndyCar, BTCC, the company has a strong revenue growth potential, but it needs cash to fund its game development and advertising. Given that the shares trade at 0.2 times our 2023 revenue estimate, we believe that the shares could carry significant upside should the company secure funding. With adequate funding, we believe that the company could turn profitable by the second half of 2023 as those games start hitting the market. We view the shares as having one of the most strong upside potential, but again, for speculative investors, the shares are rated outperform. And while there is substantial risk in this investment, it has the potential for high return. And for that reason, it is among our favorites for those that seek more speculative investments. Staying on the speculative side, we also like Engine Gaming and Media. Engine connects advertisers with influencers and provides data analytics in the esports influencer market space. The company is positioned to benefit from an increasing focus on influencer marketing, which is becoming the premier form of targeted advertising, especially among the younger demographics. Over the last year, the company has divested its capital-intensive B2C business, such as Eden Games, making for a much leaner company with a clear path to profitability. Engine has a clean balance sheet with 8.6 million in cash and 5 million in long-term debt as of August 31st. However, it will need additional funding to operate until it reaches cash flow break even, which we anticipate in mid-2023. Management has recently signaled that the company may have a strategic partner lined up for a merger. This could alleviate its funding needs. As such, we believe that the company appears poised to continue driving for profitability in the near future and capitalize on its strategic position as an integral part of the rapidly expanding influencer marketing industry. Given that the GAME shares have fallen roughly 80% year to date, despite the company's cost cuts and focus on profitability, we believe that the levels may represent an attractive entry point for speculative investors. The shares are rated outperform with a $5 price target. The last bucket I'd like to talk about is companies with strong cash flow and financial stability. I talked about a couple of them like Intravision, but here I'd like to mention one of my other favorites, Bolero. Bolero stock symbol is BOWL. It is the largest bowling center operator in North America with over 300 centers. The company has been executing a compelling roll-up strategy in the highly fragmented bowling industry, improving the efficiency and cash flow generation of its acquired centers. With 110 million in cash on the balance sheet and very high margins, in fact, we anticipate margins of 33% in both fiscal 23 and fiscal 24. The company is well positioned to make accretive acquisitions. Notably, bowling is one of the most popular experiential activities, with more Americans bowling every year than playing golf, for instance. And due to its relative inexpensiveness compared with other entertainment activities, it has those recession-resilient type qualities. Bowling has been very resilient in economic downturns. We believe that the company is positioned to continue adding bowling centers, generate strong cash flow, and outperform its entertainment and experiential peers in the event of an economic downturn. As such, I rate the shares of BOWL outperform with a $17 target. And again, the Bolero shares are among my favorites with a combination of recession resilient qualities, strong free cash flow, and a very capable balance sheet. With that, Happy holidays, everyone. Thank you.
All right, thank you, Michael. We're going to go through a few questions here real quick. First off, you listed Entravision as one of your favorites, but the company has relatively low margins. Can you further explain this?
So the margins are about 10%, which is well below that of what we would call broadcast peer group, which tend to be in the range of about 25 to 30%. And that's largely because of the way that the company recognizes its digital media revenues. Traditionally, if you looked at an agency type business, traditionally you would recognize revenues largely with what the agency would keep, that 10 to 12% of the revenues. In the case of Entravision, they recognize 100% of the revenues and then pay, let's say, Facebook, the cost of that inventory that they purchased for their client. And what they keep is the 10 to 12%. So it's just the way that they recognize revenues. Now, as the company scales in some of these developing markets, we do anticipate that those margins will increase over time. So we are anticipating the likelihood to see improving margins as its digital markets mature.
With a major election coming up in 2024, when, in your opinion, is the best time to buy a television stock? Would it be the year prior to an election year or during the election year?
So it's a good question because traditionally the television stocks react best the year prior to what we would call an Olympic and election year. In the past 20 years, on average, the TV stocks grew 22% in the year prior to an Olympic election year. And in an Olympic and election year, the stocks on average were up 8%. Most recently, the companies have actually underperformed that. And in my view, this year, they're likely to be down significantly, as we mentioned, Scripps and the likes of Great Television, both down significantly near 52-week lows. My viewpoint there is largely because we're in an election year that now has passed, and we're looking at the prospect of some economic headwinds. So in my view, now would be probably one of the better times to take a look and start building positions in television, in some of these television stocks, given that we're entering in the year prior to an Olympic and election year, when I believe the stocks should outperform as we cycle towards the end of this year.
1-800-Flowers revenue tends to fluctuate based on consumer confidence, which currently seems to be waning and will likely continue in a rising interest rate environment. Why do you think there could be positive upside surprise potential in that stock?
This is a very good question because you're right. We would typically anticipate that 1-800-Flowers revenue would have a difficult operating environment as the consumer confidence wanes. They do have a very high correlation to consumer confidence. But also what is important is that most of the analysts, including myself, have really slashed expectations for this company as we go into 2023, and already, in my view, anticipate a recession. But what's also important is that we went through a cycle of inflation and shipping costs, for instance, and transportation costs were significantly rising. And what I believe is going to happen as we cycle into next year, and what is happening now, we're starting to see shipping rates dramatically decrease. Those inflationary pressures dramatically decrease. And so, whereas we might see the prospect for revenues to be maybe a little disappointing, if we're not as conservative as I think we are, but I think we are also at the same time likely to see stronger cash flows, better margins because of those cost pressures waning a little bit.
Excellent. You also mentioned Travelzoo, a smaller player in the travel sector. This question that came in, it's how does Travelzoo represent a better investment opportunity than, say, an Expedia, which owns most of the travel sites out there?
Well, what's interesting about Travelzoo is that it's not an Expedia. So Expedia relies solely on the amount of volume and people that are traveling. So booking airfare, booking hotels, and so forth. Travelzoo is on the other side of that business. They really deal with advertising to the travel industry, and from the travel industry. So it's not a function of like an Expedia that's actually booking travel. It's a function of trying to get consumers to travel and to stay at hotels or to use certain flights. So it's a different model, and one in which that in economic downturns, people may travel less. That's true. But to Travelzoo's members, they're looking for deals. They're looking for discounts on hotels, discount on airfare, and those hotels and airlines are willing to advertise to Travelzoo's customers that are looking for those deals. So it's a different type of business model.
Excellent. So that's all the time we have for questions today. Michael, thank you for your time today.
Thank you so much, Chris.